Hey traders, this is Blake Morrow with Trader Summit, and it's Friday, and we finally, I know last week we missed him, but this week let's bring in, we have Mr. Jim Welsh from Macro Tides. I know you all have missed him, and you're excited to see him. Jim, how are you?
I'm good, Blake. How are you doing?
I'm doing great. I had a great
You're
4th of July
recovering from your
holiday.
vacation.
Yeah, it was wonderful. I know since you do live in the San Diego area, I would happen to be on the Bay, and I got to see fireworks, pretty much
You
panoramic
had
view
some
of
great
different
pictures,
fireworks.
man. Yeah,
Yeah, it was
yeah,
wonderful, wonderful, wonderful. But anyway, you know,
yeah,
the fact of the matter is, this market is unstoppable. We got producer prices today, which came in hot, yet the market rallied substantially. And I know it's kind of the opposite reaction that we
yeah.
got from CPI, but what do you make of this market reaction? What do you make of the stock market right now?
Well, again, what's happening is the internals had a huge shift yesterday. And so what we saw was a very large drop in technology stocks and a rotation into the Russell 2000, which is continuing today. The PPI is important, but not nearly as important as the CPI, which came out on yesterday. And those feed into the PCE, pardon me. And so of the three, the PPI is the least important. And, revisions up, it came in a little hotter. And it's kind of like, okay, does that change the bigger picture? Not really. So I think that's why you've seen a continuation in the Russell rallying today. And what we're seeing with the tech stocks, Blake, is after getting hammered yesterday, I mean, NVIDIA, I think, was down over 5%. You're seeing a rebound in technology. So you have, if you will, for the first time in a while, both or the broad market responding in the same direction. There was a chart I decided not to show, but going back the last 30 days prior to the last two, there were 15 days, Blake, where the S&P was up, but more stocks were down than up. Going back to 1928, the previous times that it happened were more like 11 or 12 days. So we've really seen extreme behavior with the concentration in the mega cap stocks. And what we saw yesterday was a real unwind of that trade out of tech into the Russell. And we're going to take a deeper dive in looking at this because I think it's important in terms of helping us navigate the next handful of weeks and months potentially based on this rotation.
Well, I know you say that the PPI is the least important, but we basically just clawed back everything that we lost yesterday following the CPI. So it seems like maybe yesterday's reaction was maybe an overreaction to
Yeah.
CPI.
Oh,
Okay.
no, well, again, I think what happened, and on Wednesday, I started thinking about this pretty seriously, and I almost put it in the Monday's Weekly Tech and Review, and it's like, okay, this thing's already long enough. But the idea that the Fed would be cutting rates, let me roll back. The relative strength of the Russell relative to the S&P peaked in December. Well, what was happening in December? Well, there was expectations of six rate cuts. And as those got peeled away, we saw the broad market underperform. And I think Powell's comments started the idea that, okay, we were worried about inflation. That has improved. And now the labor market is starting, the tightness is easing. So they're kind of on an equal footing, lays the groundwork that, there's more immediacy to the potential of a rate cut. And I thought it would be interesting since we've seen the broad market weaken as the rate cuts were taken away, that potentially we were setting up a rally in all the laggards on the idea that, oh, if the Fed cuts rates, we'll see cyclical stocks improve. So I think yesterday was keyed more off of that dynamic, and the CPI was the trigger, but not the main driver. The main driver was, oh, if the Fed cuts rates, all these things that have lagged tremendously will get a bid because that ensures or makes more likely that we won't have to worry about the economy slowing down too much. And I think that's what the narrative flipped, and now we have to gauge whether that narrative has legs and sustainability. And that's kind of what we're going to talk about in a little bit.
All right. Well, I know you brought some charts not only for this week, but you wanted to kind of recap a few things
Yeah.
from last week that we missed. So let's start with your first chart that you brought is ISM services. Why is this so important to our narrative and what you're seeing right now?
Well, services are about 80% of GDP. Goods are less than 15. So in terms of, hey, where's the economy going? Services are way more important. Dropping under 50, 2 out of 3 months, it's been in contraction modes. In other words, anything under 50 is quote unquote contraction. And, it was a very significant drop. So I wouldn't be surprised at all. In fact, I would be surprised if it didn't rebound a little bit. But the internals of all the components that go into this number, Blake, were pretty uniformly weak. Things like new orders dropped again significantly. Backlogs have peeled off. What that means is if companies don't have backlogs and they're not seeing new orders come in, eventually does have an impact on employment and investment and so forth. So to me, this is important. This came out on July 3rd. Well, in response to that, and we'll cover this in a minute, the dollar got hammered. Gold started to show some signs of life. So to me, this was the first real data point that came out that kind of, again, reinforces the idea we're seeing the economy slow. It's gradual, but I think this is an important data point.
Okay. And the next one is actually about unemployment rate. Now, this is something that happened the day after 4th of July. So it was a very,
Right.
very light holiday for us US traders. But I actually watched the data as it was being released from California, and I saw that it ticked up quite a bit. So what is this
Yeah.
chart
Yeah.
showing you?
Well, again, historically, Blake, when you see a shift in the unemployment rate, it's kind of like turning the Titanic, right? You're not going to do it very quickly, but once it turns, it tends to follow through. So what we can see is from the low at 3.4% in April of last year, there has been a trend higher. This is obviously something that Powell is watching. He made note of it in his testimony this week. Historically, once it trends like this, there's more follow through to the upside. So, as you know, my take has been the job growth that we've seen in terms of the establishment service survey is overstating what's really happening in the labor market. And the household survey, from which the unemployment rate comes, has been far weaker. And that's why the unemployment rate's been going up. So, again, this to me reinforces the idea that we're going to see the economy slow gradually for a while. And then, if I'm right, I think the slowdown will materialize into a recession. If not by late this year, then I think early next year. So, but again, this is all supportive of why I have been positive on treasury bond yields coming down. And we'll talk about that in a minute too.
Okay. Yeah, because that's a big move, and we're going to get to that here in a few moments.
Yeah,
Now this is yesterday's data, the CPI, and it looks like we are trending lower. We didn't get the two handle, but it looks like we're trying to make it that way, right?
we're knocking on the door.
Yeah.
No, you had some, energy prices were the main driver of bringing the headline inflation down. Core also is trending down. I think it's going to be a little sticky. What we're starting to see is housing, the shelter component weaken, and it lags by 18 months. So, the softening in shelter was like always going to show up. It's just, well, how soon and how fast? So this is constructive data. I'm sure FOMC members, after the tick up in the first quarter, we're seeing this unfold. It's a positive. And at the same time, if one looks at the economic data and you see things slowing down, well, that too is going to relieve inflationary pressures. So all this is adding together in terms of the likelihood increasing of a Fed rate cut in September. I don't think they're going to say a lot of things pinpointing September. In other words, they don't want to be in a box,
Yeah.
where, gee, come September, what if a data point comes in and it's stronger, goes against the grain? They got plenty of time, if you will, to tee it up. There's the August meeting that's going to take place as well, and there's no August meeting, a July meeting. So to me, I don't think they're going to be talking about, well, this starts to give us some room to cut, but they're not going to give any kind of time frame.
Got it. Okay. Well, then the next chart, Jim, you brought about Powell and some comments that Powell has made, and I'm assuming
Yeah.
that's this week
Yes, it
from
is.
from the Humphrey Hawkins
It's
testimony.
a,
Yeah.
yep, absolutely. So, I think the job is not done on inflation, which again is his way of saying, um, we're still going to be waiting a little bit. We're going to be vigilant, and all that happy stuff. But if we roll back the last 2 years, the Fed almost exclusively was focused on having inflation come down. Stable prices is one mandate, full employment is the other. And now, as he's pointed out, hey, we're really seeing definitive signs that the labor market is loosening up. And therefore, both of the mandates that the Fed have are almost in balance. And before they would move toward cutting rates, that
Yeah.
had to happen. And so again, there's progress here. Market says they always do. I mean, again, they were talking 6 rate cuts in December. Want to jump ahead of the game. To me, it isn't so much the timing per se, is the probability that again, I think the Fed is going to be cutting. Now it's just a question of the time frame.
Yeah.
The weaker the data, if we see more weakness in the labor market, that is what's going to pull forward a rate cut. Wall Street, I think now is about 85% set on September. So, though there's two more, employment reports between now and then. And obviously, if the unemployment rate continues to tick higher, hey, that it really would increase, I think, the potential of a rate cut in September.
All right. Well, Jim, before we get before we get back into the charts and we get into the technicals I know you want to talk a little bit about the Russell. I just want to mention to folks, guys, gals, if you enjoy this analysis from Jim, make sure you give him a thumbs up. Tell him, jump down below, tell him how much you missed him over the holiday. I'm sure he'd love to hear that from you. And make
You
sure
don't have to
you
send any flowers,
yeah,
okay? It's just,
no flowers, no flowers for Jim. Send him for his wife.
yeah.
So
Yes,
anyway,
that'd be very nice.
yeah, Jim, let's get back into the charts
Okay.
and jump into the Russell 2000. I believe is going to be your next chart here, and
It
the
is.
Russell's really, this is where we're seeing rotation. You're seeing
Yeah,
money come out of
right.
one place and out one hole into another.
Yes. So I wanted to kind of review this because if we go back to the period from 2000 to 2002, you can see the top panel is the relative strength of the Russell. So as it got above that red moving average and continued to work its way higher, that's the Russell performing better than technology. But you have to also note that there are windows of time when both the Russell and technology were going down. The only difference was the Russell was going down less. So if we look from the window of March 2000 to October 2002, the Russell was down 47%. But that was a heck of a lot better than technology, which was down 81. So my point is, one has to differentiate. There are times when everything goes down, one thing goes down less. And then there are times like from 2003 through 2004, where the Russell relative strength continued to gain traction relative to the technology sector, but it was because the Russell was going up more. And so for me, what did we know? Well, in 2001 and 2, there was a recession in 2001. We saw this big unwind from technology, the tech bubble, and so forth. And then we had a tax cut in 2003. The Fed had been cutting rates, and all of a sudden, the economy really started to come to life, and the Russell outperformed. So that to me is the framework I want to reference. And then it's kind of like, okay, let's see where we are right now. And that's the next chart, which shows the same relationships from 2019 through 2024. So again, the top panel is the Russell's relative strength to technology. And from 2014, this chart only goes back to the end of 2018. But from 2014, the beginning of 2014, Blake, the Russell was losing relative strength consistently. It had windows of time where it did better, and you can see where the black line increased. But overall, it was obviously on the downtrend. So the pattern that we're seeing here is, all right, what can we expect going forward? Well, first of all, I want to see that the Russell's relative strength continues to improve uh, compared to technology. And that's to me really important. And then looking at the chart pattern, the Russell was in October of last year was down to 1634. It rallied to 2072. And I think potentially, given what we've seen the last 2 days, that what happened was at 1932, that completed an A, B up to 2135, and C down to 1932 for a B wave. So what target can we come up with? Well, A equals or C equals A at 2360. In other words, it rallied 423 points. And if we add that, or 428 points, pardon me, I add that to 1932, that's where the 2360 target comes into play. The decline, remember, the Russell peaked in November of 2021 at 2459. So it lost about a third of its value, 825 points. So what are the retracements that we can point to? Well, it's already recovered the 618 today at 2144. It got up to, I think, 2160 something. The 786 is 2283. And as I noted, wave C, if this is just going to be a big ABC, is 2370. So to me, it's like, all right, I think what happened is significant the last 2 days. What we've seen is the propensity of traders and option buyers to play momentum. And up until 2 days ago, the momentum was only concentrated in the mega cap stocks in semiconductors and so forth. So momentum players don't care. They're just what's moving. I want to jump on board.
Yeah.
So I would be surprised if we don't see more follow through. The key for me is what we saw in 2003 and 4 was the economy was improving and strengthening, which really provided a tailwind for the Russell. I think, again, one of the tricky parts in coming months is the economy is more likely to be showing more signs of gradually slowing. And historically, that has not been terrific for the Russell. In the near term, I think the momentum will probably win and outweigh the other. So
So,
that's
what
looking at.
that's got to mean, Jim, is that if the Russell is moving higher, chances are the broad markets are going to be at least
Yes.
have a nice bid. So that means we go
Well,
higher overall.
yes. And the advanced decline line, which had been lagging rather badly, I think today will actually recover all the ground lost and make a new high in the Russell. So what it comes down to in the very short term, the sell-off that we saw yesterday in the tech stuff was a key reversal. I mean, the semiconductors, XLK, the S&P, was that wave A? And then this rebound today is a B wave and there's another leg down. I think there's a good chance of that. And if we see that leg down and the Russell's up 5% in 2 days, so my point being is I wouldn't chase right here, the Russell. I'd wait for some kind of a pullback. Maybe it's only 1.5 to 2%. But if the tech stocks, for instance, Nvidia, it could trade down towards 114.
Yeah.
It dropped $22 from 140, got to 136. Same thing. So to me, I think the Russell is going to continue to move higher. I'm just waiting for at least some kind of a pullback to find a better trade entry, if you will. Targets, obviously, there was a high at 2072, the 2135. I think a pullback to that 2135 or a little bit lower is somewhat likely.
All right. Sounds good. The next chart you brought is gold. And gold looks like, I mean, it's been constructive. But let's not forget, Jim. This is since what is that, April? Yeah, I mean this has just
Hmm.
been a big range, right? But it
Yeah, it has.
still looks like from left to right the chart's going higher.
That's been my bias, that what we've seen from that low of 1812 last September, that you had three waves up, either at 2427 or the 2449. It almost the idea being is, as you noted, since April, it's been going sideways. I think that's a wave four, and that there's a wave five coming. On July 3rd, after the ISM number, you can see how that first day that the higher declining trend line, red trend line, gold got above that line. That I sent out a special report saying, okay, let's buy gold. I think it's finally ready to make a move above 2449, and maybe we're going to 2500. I think gold was at about 2356 or a touch less during the course of that particular day. So I think we're going to see gold, uh, break out of this sideways move. The thing I would point out, wave five. So when this rally ends, whether it's at 2,500, 2,540, whatever the number turns out to be, wave five, that means we'll have completed five waves up from 1812, and we'll be ready for a more sizable pullback. Maybe it only takes us down to the 2280 level. But if, from 2500 or 2540 down to 2280, okay, do I want to sit through that? No, could be deeper. So my point is, just from a perspective standpoint, if gold breaks out, I'm assuming there's going to be a lot of, yeah, look at gold. And it
A lot
might
of
actually
chasing.
mark a high, because positioning has gotten pretty lopsided toward gold and silver. So a breakout might be the cherry on top of the sundae. So I'm just trying to keep the perspective here in terms of, I think it's going to rally, but let's not forget, if that's the fifth leg of the rally from last year's low, you're going to want to sell something into
Yeah,
that.
that makes sense. All right, because we are traders. The next chart is the dollar. It looks like
Yep.
it's getting vulnerable.
Yeah, yeah. I mean, obviously, it's been a range bound by the upper and lower trend lines, and they're coming together. As I noted on July 3rd, the dollar weakened pretty significantly. So it kept trying to take out that 106.20 level, failed. We got the ISM report. It got hit pretty hard. And then the French elections, I think, helped weaken it further because the worst outcome didn't happen. And now we're flirting with taking out that red trend line. So on Monday's weekly technical review, I said if we take out 104, 102.50, I think becomes, and look at that, goes back to the 102.36 low over there. So, my take all along, as you know, the economy is going to slow. As the economy shows more signs of slowing, that was going to be negative for the dollar. And the last week and a half, we've gotten more evidence of slowing, and the dollar's reacted negatively.
Well, the next chart might just be feeding into the dollar negative bias right now, Jim, and that's
Yeah.
with you got TLT, making a move, the 10 years making a move, which is this is the ETF. You got
Yeah.
yields dropping, and maybe that's something that's weighing on the dollar as well, right?
Yeah, absolutely. And all of it obviously feeds into is the prospect of the Fed, sooner or later, they're going to be cutting rates, and that's getting pulled forward. A couple of weeks ago, it was December. Now there's more probability of September. The thing you see that big sharp break when TLT dropped to 89 and change. Some of that was two things. A bunch of economists, 16 Nobel laureate economists said, oh my God, if Trump gets elected, inflation's coming back. Now, coincidentally, that came out the day before the debate 2 weeks ago. And as I noted, and I showed a table of deficits under Trump, which were 3.5% to 4%, a little bit over 4% prior to 2020 and COVID. And then Biden, it's like, 6 to 7%. So these guys are saying, okay, Trump's budget's going to cause inflation. I think they might have been a little partisan because they, conveniently overlooked. But that idea is one of the things that hit the dollar was, oh my God, we're going to have inflation comes back and the Fed won't be cutting rates, blah, blah, blah. I thought it was baloney and that we would see TLT and yields come down. So far, so good. Getting above that 95 range, to me would be a very positive development. It's kind of like we've been building this base going back to when is that? Let's see,
It was
June,
basically April.
April,
Well, actually
March.
March. Yeah.
Yeah, so to me, getting above that 95 area technically will kind of say, hey, that actually, kind of sealed the deal. That was a bottom. And, the range from 87 to 94, 7 points. And you add that to 94, 95, and you get up to 102. The high last December was 100.57. As you know, I've been saying and believing that TLT was on its way above that number, which is why buying it to me made sense. And again, this is only going to happen if we see the economy show more signs of slowing and we see the more likeliness that the Fed is going to be cutting rates, become really a reality. So, I think that's a plus.
Well, it's going to be interesting, Jim, if the U.S. economy does slow, and do stocks actually finally find a top? But as far as what you're saying right now with the Russell breaking out, it seems like the stock market probably has some more to go to the upside.
That would be my conclusion.
All
I
right.
think again, there's this window, and I've talked and written about this, is that you get enough slowing to convince people that, oh, now the Fed's going to be able to cut rates, but not too much slowing. So it starts to raise concerns about a recession. So you have this window where you're in a perfect nirvana. Hey, the Fed's going to cut, and that's going to be great for cyclical stocks, things like the Russell and so forth. The ultimate thing, that window closes if and when we see more, I think, if more definitive signs that the economy is not just slowing, it's slowing more than expected.
Right.
But that
All
could
right.
be a few months away.
Well, Jim, a few weeks is like if for us traders
Lifetime.
is a lifetime for us. So I want to thank you for being back with us. I know a lot of you have missed Jim over the last week because he was enjoying a holiday, as was I. So if you did, make sure you let him know in the comments below. And Jim, what's the best way for traders to get your current work and
Yeah,
get
Jim
a hold of
Welsh
you?
Macro at Gmail.
Jim
Or
Welsh Macro at Gmail.
thank you, and macrotypes.com to get more information.
All right, and make sure you let him know that you saw him. You saw him here on Trader Summit. And Jim, I want to thank you for spending your time with us. And I'm going to look forward to catching up with you next Friday.
You got it, buddy.
Hey traders, Blake Morrow here. Thanks for stopping by our YouTube channel. Don't forget to like, share, and subscribe to our channel. Also click the bell notifications so you do not miss any of our market-related trading analysis from some of the leading industry experts. Thanks for stopping by. We'll see you in the next video.